Okay, very good. Well, thank you for that. It's always good to get a lot of information from you guys as well. You know, it's pretty important from my side to understand where people stand on a um, on a logical level in terms of knowledge. But you know what? What would be a really good thing to create a call where we do a small private group session, for example, about 10 people or maybe 15 at max, the ones who are the most dedicated, and sit down and actually go into an interaction style of let's say a workshop where I would gather intelligence from them, where we would understand more information on their trading, their goals, their fears, their hopes, and so forth, and then use that to create a specific trading approach. But we can talk about that another time in more detail. For now, I'm going to share my screen. Let's get this going. So I prepared a small PowerPoint, and I want to specifically talk to you guys about 5 simple ways to cut trading mistakes. Roger, can you just confirm that you guys can see the PowerPoint and that I've shared the correct screen?
Yes, we can.
Beautiful. Thank you very much. So we're going to go over 5 simple ways to remove trading mistakes. Now, removing trading errors. I used to believe that I'd never get over the hurdle of becoming a consistent and profitable trader early in my career. And early in my career, I'm talking about the first couple of years. Things were going good, then they were going bad. Things were going good, then they were going bad. Eventually, things started going very good, and they are going very good. For example, this week, Monday, Tuesday, Wednesday, very profitable. Thursday, totally red. And today, so far, even though I've got free trades open, it's going okay, but I'm hoping to end in the next two hours. I'll make a decision on whether I'm going to keep these trades open for the weekend. We're going to go over a summary of today's trades. But for now, back to the PowerPoint. Now, I'm sure we've all come across that point in our trading career. And if you haven't come across the point of not fully believing that you can make it and even having doubts in yourself, that's fine, because everyone's been there. If you guys read, there are some very, very good books that I highly recommend you guys read, and that would be Unknown Market Wizards, Hedge Fund Market Wizards, those books. Jack Schwager, amazing books. The books are based on interviews between real traders. And you're going to see that most of them, well, actually all of them, have had a horrible beginning. You know why? Do you know why they became good? Because of what they did throughout those bad times. You got to have the resilience. And this is, I didn't list this as a clear topic, but I want to talk about resilience for a second. And I'll connect it to basic things in your life. When you guys started walking, and I told you guys this before as well, when you started walking as a child, you didn't give up the first time you fell down. The first time you drove a car, you didn't give up because you didn't know how to shift gears. Or the first time you started writing, you didn't give up because you couldn't draw an okay circle. You didn't give up writing altogether. Talking, thinking, making love, cooking food, and so forth. You didn't give up because of the first bad or error that you had as a human being. You kept going. You became better and better and better and better and better. Repetition. By understanding you're not good at something, acceptance of it is the first and most important, and I would say vital, component towards becoming successful. So let me assume, actually that's a typo. Now, with proper mechanics, which is a trading system, that's what I would call mechanics, because this is a mechanical trading system that I use, and routinely avoiding the most common trading mistakes, the doubt will go away. Now, how does the doubt go away? The doubt goes away by creating knowledge, by gathering knowledge, using that basic knowledge and turning it into know-how through application, and that's how the money follows. The money is a byproduct of repeating and doing the necessary deeds. Now, I'm going to go over 5 basic principles today about this, okay, removing trading errors. Now, I know a lot of you have already heard these 5 principles to a point where I might even sound like a broken record, but I believe in repetition because people don't completely understand the subject I'm talking about well, so I prefer to repetitively explain it. These principles are vital and need to be repeated and embedded within our brains to remind us what is important so that we can be at our best when we're trading. And that's vital towards trading success. That's why it's so important to truly practice the principles I'm going to talk to you guys about. The minute you enter in the markets and the minute you leave the markets, I would say what I'm about to go over is vital. Now, following these basic 5 principles will assure longevity in your trading, but you still need proper mechanics that I talk about in the earlier sessions. And what is that? A complete trading system. Without knowing where you're getting in, how much are you getting in with, where are you getting out, and where are you targeting as a profit, you do not have a complete trading system. You have a random trading system. But anyway, we'll talk about that too in a while. Now, the first one is having good risk-reward ratios. For me, as a rule, that's 2 to 1 as a minimum. Now, let me explain to you the 2 to 1 principle. And I'll use a pen and paper for this, but let's say you have a starting balance of 10,000. You can have anything. You can use 1,000 here or whatever. But as an example, I want to go over 10,000. You have a win ratio of 50%. That means you lose 50 trades, so put an L, and you win 50 trades. Now, this is basic mathematics. I'm going completely elementary on you guys. 10,000 starting balance, 50% win ratio, which means 50 losers, 50 winners. Your risk-reward ratio is 2 to 1. Let's say you're risking $50 or 50 pounds to make 100. After 100 trades, you would have lost 2,500, while you would have won 5,000, right? That's basic math. You have a net balance of 12,500, giving you a net gain of 2,500. Basic. Most people don't want basic. When it comes to their hard-earned money, they prefer to complicate things to an extent where they just go crazy and start, playing the casino, because this can be a casino if you turn it into one. Now, any trade you will ever take involves some form of risk, and that's pretty simple. The greater the risk, the greater the reward. But your reward should always be higher than your risk, preferably, and I even messed up here, not preferably, mandatory to be at least 2 to 1. If you're risking 1 to get 1, you need to have a very high win percentage to actually make money out of this. And one big loss out of the 1 will totally wipe up your profits. I have it as a rule for myself to target at least a 2 to 1. In most cases, it's way higher than that. It's 6 to 1, 5 to 1, 4 to 1. And many times I'll close earlier or compound the trade towards that level and make a bigger profit. Now, that's truly the only way you're going to succeed in this business in the long run. Having proper or just a good risk to reward ratio or reward to risk ratio. So a good one is 2 to 1. A great one is 3 plus. Extraordinary one only comes with unicorn or whale trades. And those trades don't come around all the time. That's why you need to have your margin. And by controlling your exposure, which we're going to talk about in a little bit, you're going to always have margin to take advantage of the big trades that come along, or the big and aggressive market movers that could make you money. Now, I'll go over this again. Any trade you will ever take involves some form of risk. Absolutely always. There's no guarantees in this business. The greater the risk, the greater the reward. Your reward should always be higher. As a general rule, at least 2 times higher than your risk. If you're risking 10, you have to get 20. If you're risking 100, you want to get 200 plus. That's truly the only way to succeed in this business in the long term. That's why it is vital and it's very important to ask yourself before you enter a trade, does this trade that I'm about to take really set itself up for a minimum return of at least 2x greater than what I'm risking? Now, my solution for this is a definite entry. Oh yes, I forgot to tell you, each slide will have a solution. Each problem will have a solution, but my way. The things that work for me in real market environments are going to be shared with you right now. So my solution to having a good risk-reward ratio, or even a great one, is I only enter at the fibs and only at the fibs, and I use the ATR in order to get a minimum reward of 2 to 1. How would that work? Let's go to the trading station here. I have DAX open, 3.7 3.7 is my risk reward, meaning I'm risking 1 to get 3.7 if price comes up here. Now I'm going to explain to you guys why we entered this. First of all, I missed this entry down here. I actually told my team that I have people who work for me. We manage money. So yeah, that's the team. Now we've seen this here. This was a contraction. Price broke out, and I'm expecting this to be a continuation. Price already tested 38.2. I did enter within the 61 and 54 range. We came very close to a stop out, but I wasn't worried because there is a rule that I follow. If the price breaks through, my stops are in, so there's nothing for me to do. Very simple. When you have an SL and you use proper position sizing, for example, here, let's say I have 20,000, my balance is 20,000, FX, I'm opening 3 to 4 lots. If I don't know what I'm doing, I'll open 3 lots here, risk is here based on the ATR, and my reward is here. Now, I've got other options for a reward too, using the fibs. By the way, we're going to talk about this in detail pretty soon. So 1236, 1382, and 1618. At this level here, even if I target this, my risk reward is still very solid, 2.35 to 1. It's above the mandatory risk reward. So if price comes here prior to the close and price actually stuck over there, believe me, I'm going to take the profit because it's Friday. I made good money this week. Might as well take it. So this is the criteria for me to enter a trade. It has to be at the fibs, and the indications have to be bullish. Now, what are the indications? I'm gonna open this somewhere else. This is on Oanda, so I'll open it on this one. No, that's B30. That's US30. OandaCurrency.com here. So check this out, just so I have a clean chart on my existing one. Now, price action. Price action is king. If you guys remember the previous sessions, I spoke about to learn the language of the markets, and that's price action. Using the Dow Chain channel, you're going to be able to see these straight lines. This indicates tops and bottoms. So check this out. Price has been coming down, right? Made a strong push up, which is higher than this one. This is the low, hence I take the fibs, I do this, and I enter. Now I enter either in the first zone, which is 61.8 and 54, or the second zone, 38.2 and 30. So as a basic point, I decided to take this trade. Sorry, just a sec. I decided to take this trade here, thinking that it's going to go from there. It did push up, eventually pushed down, went up. In a small profit right now, not big, but it's in a profit. And it's going okay. And I think that there is high potential for upside because the bottom sides are coming up. Low, higher low, and I'm expecting price to either retest this or continue from now towards the upside, towards the end of the market, because there is going to be a trend. The market always trends towards the end of the market. It's either going to go down to my SL or go up towards my TP. Now, I'm going to go and explain this in more detail a little bit. We've got a potential head and shoulders here, with this being shoulder one here, head and potential shoulder. Now, if this isn't the shoulder, price might do a zigzag, come back here, and then go up. This is at least what I'm foreseeing that could occur now. Of course, I could be wrong, but that's my definite entry. And this is just one example. I have a definite entry. I use the ATR to enter, to set my SL based on the current price. In that case, it was 66.1, hence 66.1. Now it's 91, but that only increases the chances of my take profits getting hit because that indicates that there is more volatility in the markets. If the ATR, which is the average true range, is going up, it means that there could be a bigger move in the markets. We'll talk about this another time. But that's exactly what it means. If this line is going up and this number is going up, it means volatility is increasing in the past hours. So that's my solution. You guys can create your own solution in any way you like. It can be any type of entry, but it just has to be definite. If you don't have a definite entry, believe me, you're not a complete trader. And you're going to have a tough time in this market. Because what you're going to do is you're going to swiggle around from one strategy to another, from one entry process to another, and you're just going to get lost. And that's not going to work out good for you. Number one, having a good risk-reward ratio is one of the best ways to actually create longevity in your trading. Longevity, I'm pretty sure you all know what that means. Number two is having proper risk management. Now, I guess this is a big topic. Now, trades don't always go our way. That's why the very first thing you should be thinking about is risk management. In fact, even though I do good with my trades, I make good money, live off the market, I still think of risk management to this day as my optimal and the most important and vital part of my trading. No matter how good my system is, it loses money, and it will lose money. I don't think about how much money I'm going to make, and that took a while to do, like to get it to click through my mind, so I can stop thinking about the money and focus on the process. And I'm going to tell you this as a fact. You need to stop thinking about how much money you're going to earn. You need to start following a proper process, and by following that process, the money comes as a side effect. It's kind of cause and effect at the end of the day. It goes the same way for business. If a business has good to great services or products, chances are it's going to have good to great results in those products. Same goes with your attitude at the end of the day. If you have a poor attitude, poor or average attitude, you are going to be achieving poor or average results. If you have a good attitude, you're going to get good results. But if you have a great attitude, you're going to have great results. Same goes for trading. Focus on the process, the money stuff, let that take care of itself. As long as you've got capital to trade with, which comes down to risk management, you're always going to be able to fight another day. And you don't need to think in terms of, I got to make money today. Don't think too short term. You need to be thinking long term. I'm thinking this decade. I'm not thinking, oh, this month. I'm thinking this decade. I've got goals for this decade. I know where I want to go. And that end goal might change in terms of how much I will be making in the markets and what I'm going to be doing in my overall AUM and so forth. But I know where I'm going. That's what matters. If I'm going to get there, that depends on what I do every day. And without risk management, I'm doomed to fail. Now, I'll give you another better example than this. Today, you, Dean, Daisy, Russell, Nicole, you guys can sit down and make 10 billion% in return. But if you lose, you can only lose 100% of that to be completely gone. So you can make 1,000,000,000% return, or 1,000,000, or 500% return, or 100% return. But to go bust and to completely blow up your account and lose everything you've got, all you need to lose is that 3-digit number, 100%. But if you lose 50% as well, and many people don't think about this, why do I try not to go into the double digits? Because I can recover a loss of 10%. Hell, I can recover a loss of 20%. But when you're 50% down, that's when the real trouble starts. Don't worry, if you're 50% down, we can recover that. It's easy. But the problem is you now need to make 100% to come back, to just come back where you were. Think about it in basic mathematics. If I have $100, I lose 50 of that. For me to come back to 100, I need to make 100% of 50, because 50% of 50 is 25. This is why you need to protect your capital. And the best risk management you can have in place is very simple. Have a stop loss. If the stop loss I released to you guys seems a bit far, especially in the last week, lower your position size. If price comes down towards the SL, I'll give you an example soon, buy a little bit more, put the same SL. Price matters for me. That SL is definite. It's not moving. If it moves, I inform you, but don't move it by yourself. Now, regardless of whatever happens to the trade, respecting your stop loss will assure minimal losses. A stop loss is the first thing you need to set when you enter a trade. And I'm sorry if I might swear here and there. I do that to get my point across. But if you don't set a fucking stop loss, you're going to end up broke. I promise you. Okay? It's very, very important. You're going to lose your money. You're going to be broke. And then you're going to blame it on the market. You're going to blame it on this guy and that girl and this one and that one. But you're not going to take responsibility for not taking that effing stop loss. Because if you're not willing to take a stop loss, or just put a bloody stop loss in, you're not going to do good. And I'm telling you from now, just you better give up on this. You know, you're not going to do good, because I don't want you to be losing money. Nobody wants you to be losing money. But if you want to be losing money, then don't set the stop loss. If you want to protect your capital and be able to fight on the next trade and actually make money, set a stop loss. And again, the first thing I do is I set a stop loss. My solution, always use position sizing. We'll talk about that now. I want to show you WTI and just explain to you how price action works. WTI is in a massive uptrend. Watch this. WTI is in a very strong uptrend. We haven't seen such an uptrend in a very long time. Now look at this. If I come to Finviz and I check, this is a really good website to find market movers, and I go on energies, WTI this morning, it was up. It was up when I prepared my watch list 13.9. It's still up, crude Brent oil, and WTI 17.4. But I want to show you something. I'll clean the charts and I'll show you something important that's happening right here. Check this out. There is a low, there is a lower low, and there is the final low. Now, price action, if you check the 1 hour chart here, is actually moving towards the upside. Even though this dip here, that's totally normal. If you guys remember, we bought this last week, made a profit on it this week. If you guys remember, I released that trade idea, but look at this. This is basic price action for you. The last dip of price, so this is one move to this move. Price came from here and then created the lower high. Here, we just had higher lows. That's an uptrend. Price came down and then started the next move. That next move literally connects to the last layer of the fibs. And here you have a low, lower low, lowest low. This is the called, I've actually pretty much made this pattern myself. I've never seen anybody use it. Maybe somebody does, but here you have a contraction of price. And now this is the indication I was talking about, that there could be a bull break on this and price would be going up. Now, let's say you want to enter into this trade. Criteria for me is valid. I could enter into this. We are at the fibs. There is a contraction in free lower lows. The ATR is 82.7. 82.7 is right around there. I'll show you. And set it here. Now, to set a take profit on this, it's very simple. You can always use the fibs this way as well. Take the recent top, take the current low, and then just take 61.8. Now, if you guys look what 61.8 lines up with, lines up with a peak resistance right there. The recent resistance of price. See? 123 lines up with this, and 138 lines up with this. And if you don't believe me, I'll just put a straight line down the middle and you'll see that there. So this one, 1382 lines up with this one, and this one lines up with that there. See? The fibs will usually line up to specific levels, key levels that could be targeted. But we spoke about a solution here, this here, always use structured position sizing, and that is literally one way to control and have proper risk management. If your balance is, for example, let's say your starting balance is whatever, we spoke about this many times, but let's say your starting balance is 500. To enter a trade on oil right now, the lot size I should be using is 0.03 to 0.05. I shouldn't be exceeding this. Okay, it's called structured position sizing for a reason, because it gives you structure in your trading. And believe me, every real trader in this world uses position sizing. It's very simple, because if you do not use position sizing, you're trading randomly. If you're trading randomly, you have no overall control of the outcomes of your trades, because one loss could totally wipe you out. Position sizing is the most important thing. WTI is dropping now. Getting close to total stop out there, but position sizing, clear as daylight. The most important thing you need to be focusing on is position sizing, especially when you don't know what you're doing or you're not very good at something. Start with 0.03. Now I'm going to give you another way to completely test the system to see if there is an edge, because that's what a complete trading system should give you. a positive edge. A positive edge means that if you repeat the process, you're going to make money. Because there are no guarantees in this market, you need something that's going to confirm if what I'm doing works, or let's just keep it to that. But it's 20 trades. You need to open 20 trades. If you open 20 trades over a series of time, I'm done with WTI. It's crashed totally, but I'll wait and possibly re-enter. There's still 30 minutes to go for this candle to complete. 20 trades. 20 trades is what I use to backtest any kind of idea I have or any approach. But even though I'm testing or whatever else I'm doing, I'm using structured position sizing, because by using structured position sizing, I get to grow my account. I also have a specific target growth, 10, 20, 30. By using this 30%, for me to grow 500 to 650 to 30% is 650. And as my balance grows, so does my position size, to reflect the process and help me achieve my 30%. So the next one, all I need to do is make 195 to achieve my next level. The problem is most new traders, they're going to come here, they're going to make 150, they're going to make 30% in one day, and they're going to continue fucking trading. And that's one thing that you shouldn't be doing. And excuse me for my language, for swearing, but I do it to get my point across. It's a big no-no. If you reach your 30%, 10, 20, you don't need to sit here and do it all day, because then that is classified as gambling. And that is going to lose you money. I can't emphasize, even if you're using position sizing. The only difference, if you have a negative edge system, the only difference between position sizing and not using position sizing is you're going to lose your money slower. That's the only difference. But losing your money slower will also help you learn to trade better. I hope that makes sense, but yeah. Let's go over the next point now. Having a plan. Every trader has a specific trading plan that they need to follow. Now, this goes without saying. If you do not have a plan in place at the time you like to trade, you have no business trading. You need to, I'm going to go over some points, but you need to truly look at the markets and see how they're reacting. And when I say that, I mean you need to be trading what you see. I told you guys in the first session we had that the markets speak one language and one language only. It's not English, not Chinese, not German. It's not Russian or Turkish or any other language. It's price action. And that's what you need to learn. Price action as soon as possible. When you understand price action, you're able to take advantage of the markets and find solid trade ideas. And I'm going to show you this live. This market is still bearish until proven otherwise, because these highs are getting lower. The lows are now getting lower as well. And until we do not break these previous highs here, this market will be bearish. That's why I've taken my loss and I'm ready to move on. Of course, GBP/USD is still bullish and still in profit, and I'm still expecting it to go up. Now, why? Let's go over the why. The highs are here. We've broken those highs and we're making higher highs. But what is more important to an understanding of whether the market is changing direction, it is the lows. Are the lows getting higher? Yes, they are. Each low is getting higher. Of course, they're very tight, and one low towards the downside, breaking this would classify this now a bearish movement. But the good thing is the GBP is in a massive bullish run. We've had a massive sell-off today and yesterday. And what's happening now is we have a lot of indecision here, a lot of indecision. Our take profits are close and not too far away, and the GBP could hit them very easily. And by the way, I sent you guys a message that GBP was a TP1, and I told you that you can take it if you want. I'm riding to TP3, and TP1 was based off this structure here. Price came down, came up, came down. There was the re-entry, and there was TP1. Of course, we came back very quickly from it. The DAX is going okay, and I'll show you the indications on the DAX. Still could remain bearish because we haven't yet broken the previous high. This is my take profit. And if price cannot push above this, or even about this for now, and cannot create higher lows, then this trade idea is done. My solution to creating a watch list. Now, I'm giving you direct information of what I do. Some of it might sound boring, but it's what makes me money. Find movers. I use different websites for this. You can use Finviz, that's finviz.com, and go to the futures screener and then choose performance. I usually do this every day. I sit down and go indices. I see what's moving, what's not moving, and I come to my trading journal and I write this down. Based on what's moving, the DAX is down for the month, WT up for the month, silver up, gold down, a lot of indecision there. Wix is up, JPY down. And based on this, all I need to do is come to USD JPY, for example. Since it's weak, right? Since the, Since the JPY is weak, I should be looking to sell it. And if you guys focus on basic price action again here, as we just went over this, the lows, the highs are getting higher. The lows are getting higher. These are all opportunities to buy, but you do not buy high, you buy low. And how do you do that? You use the fibs, because they'll always give you an excellent reason or specific price. That's the better word. That's a better way to say it. A specific price to enter. You just take the recent top, the recent low, and you have entries. You had an entry here, which you wouldn't get stopped out of. You had an entry right there. You had an entry here. You had an entry here. You had an entry there. All of these are entries to go long, and then all you need to do is target the next fibs. When price action when your trade goes into profit, all you need to do is move your stop loss into profit. That is one way. Movers. Next is charts. Come here, and if you have the time, multiple time frame analysis, set 1 hour chart here and a 10-minute, a 5 minutes, or a 2-minute here. And as you can see here, gold coming crashing down here. Lower highs. Should have completely changed my idea here, by the way, after seeing this. Lower highs. They are connected with the trend line from this way. And they're getting lower. So there is a contraction of price. Price action broke out and tumbled down. Now we're building a potential continuation. All I need to do from my side is do this and take an execution trade here and go short. And then go to the next trade and continue looking. And then what am I looking for? I'm looking for basic price action patterns. Head and shoulders, double tops, double bottoms. Seeing this, for example, price making lower lows, lower lows, lower lows. Just checking what's going on. Space. All I need to do is click space. And by clicking space, I'm finding more and more and more information about the trade. That's number 2. And number 3 is news. All you need to do is go to Forex Factory or investing.com. And by going there, you can check the calendar and you see we've got the G20 meetings happening today. On Monday, you have this at 4 p.m. my time, 3 p.m. your time in the UK. And all you need to do is be at your station 15 minutes before this. Open up your trading station, check what's going on, see where momentum is going, look for patterns, take an execution. Use position sizing, have a definite SL, and the chance of you making a profit now significantly increases because you're trading liquid markets, things that are moving. That is how I create a watch list. Next, and this is a hard one, and the last one, do not overstay your welcome. The longer you're in the markets, the heavier your risk exposure will be. Now, what do I mean by this? The more you sit at your station and look for trades, the more risk you increase on add in your trading. The more trades you open, the more risk you add. So keep that in mind. We have to remind ourselves that most traders lose their money, and the longer we stay there, the more chances we have of losing. Now, to truly succeed, you need to implement your game plan, and don't get greedy. Take profit when you need to take it, or lock in. Now, my solution is profit at specific levels, and those are free levels, and I'm going to go over them again. They are the fibs, For example, NASDAQ is indicating a reversal now. Let's look at the basics of price action. Look at this. This is the previous high, right? There it is. Now we've broken that high. What are the lows doing? Low, higher low, higher low, higher low. Now look at this. See this? Bottom to top. Now I'm going to take this trade. Give me a sec. I'll take this trade live. NASDAQ. Now I'm going to use this in a 2,300 euro account, and I'll show you how we do this. This is a test one. 2,301. Position size. Indices. 0. Is it right? Yeah, 0.67. 0.67 execution. Entry. I'm in the trade. I'll show you guys now. There's the trade. What do we do? What is the first thing we do? The first thing we do is we set our stop loss. 208 points. With indices, we can cut that in half to 104, which is even very wide, but completely removes the risk I possess. So now, based on the ATR, the risk I have on this trade is 4.5% or 104 euros, right? That's the first thing you do. Then you look for profit. So if I go to this profit target using the 1 hour chart here, I can see there is a bit of support at this level. That doesn't give me the risk reward I want. 4.4 for 4.5. I'll lower my risk here to increase my risk reward and make it more logical. So I'm going to go, what was it before? 200 and 200, so 104. So I'm going to go to about 50. Well, not 50, actually 90, let's say. And I'm going to increase my take profit to 138, and I'll show you why. The highs are getting higher. Higher high, higher high, higher high. Structure high, higher high. The lows are getting higher, right? And 61 looks like the best logical target because it lines up with this resistance. You see this? So 61.8. Take profit, stop loss. If price action comes and makes a move and breaks the previous low, which is here, this trade will be classified as over. But my risk reward now becomes a bit better. 7.7, 7.57 reward for a 2.2 risk. Now, the main criteria when I set a stop loss for me is, of course, to use the ATR, but also to always be below the previous low, and that's this. Now, if I come down to the 2-minute chart, I'll have a contraction here as well. Price action giving me a bit of a trend line right there, giving me a support level here. And what is that? That is a contraction of price. And now we have a breakout. The chance of upside increases, but doesn't give us a guarantee. We were talking about profit targets. So again, find a key level that price action could hit, such as this, which is now the next high that price action would target. And we have this one here where the Dogecoin channel made a small step, which is this. So now I have two potential profit targets. What I'm going to do is I'm going to set myself an alert at 1236. And when price action comes there, I'm going to get an email on my phone, and my phone is going to say, hey, NASDAQ or US Tech or US 100 is coming to the first take profit, which is a potential resistance level. All I need to do is open up my phone, go on TradingView or whatever platform you use, and watch price action. And how do you watch price action? You come down to the 2 or 3 minutes or 1 minute and just check. And if price action is moving up and creating higher lows, as is here, because you have this low, price made this high, you have this low, price action made this high. So as long as this low is intact, then that would indicate, more upside. But if this low breaks, the trade's most likely over. So that's it for now. Do you guys have any questions for me? I can't see
I've got
that.
a couple of questions, Dennis, that I'd just like you to
Go
go over. Some of the new guys that may not have seen the calls during the week, can you just explain what ATR is for them? I have my notes from the week, but for the guys that
ATR stands for average true range, and the setting I use is the following. It's indicator time frame is set to the last 2 hours only. Length is set to 5, and smoothing is set to EMA. So those are the settings. Now to see this number here, this 208, all you guys need to do is click here, this little sun or whatever it is, and go to labels and choose indicator last value. That'll give you this number. That is the direct component of the volatility the asset has been experiencing in the last 2 hours. And that gives us the stop loss. It gives us the maximum SL we should be setting. In this case, the safest stop loss would have been 208 points. And because it's 208 points, it also indicates that if there is a move, it's going to be pretty big. Now, I would normally be targeting this red level here, which is the point of control of the market from here that hasn't been tested. So that would be normally the take profit I would be shooting for. And if I did that, and I'll show you now, if I enter right now and use the ATR of 208, which is here, it gives me the safest stop loss, which is literally, in reality, it's 20 pips, real pips. And then target the take profit of this, I have exactly a 2.02 to 1. The ATR is used to set your stop loss. The number there tells you the safest SL you should have.
Okay, perfect. Question that I saw in the group, and I'm going to answer it. Question from Ryan, and that was about your spreadsheet. I've got access to the spreadsheet, guys. I will release the spreadsheet to everybody after this call, and I'll send it in the Telegram
just a comment on that. You guys need to click, when you come to the spreadsheet, click File and then choose Make a Copy. That way you're not gonna be in view only mode.
Yeah. Yeah, just in view only mode, it's just dead. It doesn't do anything. So
yes,
but I will make sure that that's available to everybody after this call. On the basis of that, and we just saw you just looking at a trade, and it suggested that you were looking at a lot size of 0.67 on an index.
Yes.
Now, the majority of our guys have one broker.
Yeah, and you can't.
So the question's not that. We'll understand that it's going to be IC markets need a minimum lot size of 1.0. I have more than one broker. I use a different broker so that I could put 0.67 in if that's what was required for me. How many brokers would you recommend someone has multiple brokers if they're in a position to do so?
I would recommend 2 brokers. It's always important to have diversification. Just like a bank account, you shouldn't put all of your money in one basket. I have 3 brokerages that I use, but I recommend people to have 2, at least 2. And not trade both accounts at the same time. This is really important. If you're trading on one account, forget you even have the other one.
Yeah.
Because you don't want to be running around, because when the market moves, everything moves. And that's the last thing you need is, a mental hurricane in your mind.
Absolutely. Okay. Guys, do any of you have questions? Put them in the chat. Or even unmute yourself if you've got a question.
Yes, unmute yourself. It would be easier. It can be anything related to trading. Maybe something you're doing wrong, or maybe something related to price action.
Something you just didn't understand.
Dennis, I've got one, if that's all right.
Absolutely.
Do you know how you use 2 charts? Chart. If you're not paying for the trading view, is there any other way that you can actually get 2 up at the same time? Not as in a split screen, but on 2 different web browsers, if you know what I mean.
Yeah. You can just open 2 browsers and split them in half. You understand? You could do that, or the easier way to do it is, this is what you see now. Set this up, find the asset you want to trade. For example, let's say this, NASDAQ. We see that there are indications that price action could go up even from the 1 hour because we're coming off this support. Just try, guys, if you use the Dow chain channel, set it. And when you see a strong line like this, that means that's a very strong support. The reason the Dow chain channel is creating this straight line is because when price action came here, it moved away from it without making much pullbacks towards the downside. Now that explains to us that this is a strong support. So look, Ryan, you're using this. Make sure you click this top left button. You see this little arrow?
Yeah.
And click the stars on the time frames you see. Because on the free version you don't have all of them, I think.
Yeah, I think you're missing like the 10 and I think the 10-minute one's missing on
that's
the
fine.
free
Use
version.
15. Use 15. Use what you got, you know.
Yeah.
And click the stars, and then you're gonna have the time frames up here this way. So all you need to do is come here, you know, do your analysis on the 1 hour, and then come here. And I highly encourage you, pay attention to price action. Because on the 10-minute chart, we clearly see that price action has made the low, made the high, made the higher low, made the higher high, higher low, higher high. That's the reason I just took that trade. Boom. You set your fibs and you got your definite entry. Never enter outside of these levels. If price action is here, don't enter. Don't rush. There is no reason. If you really want to rush, set yourself a pending order and you're going to do just fine, I promise you. But this is the best way. This is how I, in Cyprus, because I can't go to Cyprus now because of the lockdowns. In Cyprus, I have two curved 49-inch, what's it called, LG curved monitors. And I use just one screen like this. Of course, the screen's very wide and I get to see a lot of data there. But I don't use multiple time frame there. I don't use this. But this just saves me time. This just saves me time. Your success will still be the same. Just, you know, always check the higher time frame first, map it out a little bit, see what's going on, make sure you're using volume profile. The way I would use volume profile here is I would take this first red candle and drag it to the front, and that would give me the structure of the pattern. So I know that if I break out of this, I could see a rally and price action could very quickly come to my take profit. On the other side, it could also be a resistance for the day. You know, and then all you need to do is come down to the 5-minute. I think you got the 5-minute there. And then just, or 15, let's say you go to the 15 and just focus on the highs and the lows. That's all you need to focus on, price action, nothing else.
Perfect.
I hope that helps, Ryan.
Yeah, thanks very much.
A couple of questions one question that you reminded me of. That was right at the beginning when you were talking about your entry. You were talking about entering at fibs, and you suggested an entry range. What would you say the entry range is from the price that you send out? If it's varied by, is there a specific number of pips that you would count that you would say entry range is this, and if it's outside of that, don't enter?
Because each asset has a different pip value, I wouldn't say pips, but I would say that people should set the fibs, or let me think about this a little bit better. 1 second.
I'm thinking of people that are not necessarily sat in front of a monitor when they see it.
The entry range is this here, these two numbers and these two numbers. And then anything in between that is okay too. So let's put it like this. What I'm going to do is I'm going to send you guys a chart from now on. And you guys, it will be up to you to determine, or just look at the top number here of 61.8 and the bottom number of 30. If price is in between that, you can enter. If it's above, you don't. If it's below, you don't. Only in between these numbers can you or should you enter.
I think that would be spectacularly helpful.
I will send the charts out for educational purposes as well. I think that's going to help a lot.
Yeah, fantastic. Thank you. Okay, a couple of questions first one's from Michael. And Michael's question was, could you quickly again show how to use fixed range volume? Yes,
fixed range volume is very important. Fixed range volume could be used on all charts and should be used. But first, to explain to you how to use that, I need to explain to you something else. How to get the structure of the market. The market will move from point A to point B until it retraces. Now let me explain this again. The market moved from this level to this level, and then it hit this level. That's one stage of the market, because in this range, price was creating lower highs. We came, we did a retest. Now we went from here to here. If we didn't have the current day here and we were trading this market here, I would be taking the fibs from the volume range from there. But to make it simple, price came here and then came down. That means you're going to take the fixed range volume, and what you're going to do is, especially on the Heikin-Ashi chart, the first red push, in this case 1, 2, 3, 4, there were plenty of red candles. Not from here, but from here. Click there, drag it to the front, exactly where we are today. And by doing this, you're going to get this highlighted area and the unhighlighted area. The highlighted area gives you support and resistance levels. There, you know, they give you the structure or the range of the place. So price action could do this before it breaks out either here or breaks out either here. After the breakout, what you need to understand of this is that there are three things that can happen. Price will either continue up, retest this and continue up, or create a fake out and come right back in. The funny thing is that's how the markets work. We don't know what they're going to do, but we anticipate what it could do using price action analysis, higher highs and higher lows. So if you come down to the 2-minute chart here and you witness the following happen, price action broke out, right? We're above the volume, you see the orange level, but you have a lower high. Price action tried to break it again. The high is pretty much in the range of this previous candle. That's your go to say, okay, it's not working out, I'll get out. But on the other side, if price action now breaks this level here, you could be classified into, the market could be classified as bullish again. I hope that answers your question. But I'll give you another example on a random pair there. Oh, horrible one, CHF JPY. But anyway, I'll show you. 4-hour chart. The market came from here to here, top side, right, and then went down. You take the fixed range, you take the first red candle, drag it to the front. Now you see the structure of the market. It's here and down here, giving us the chance, as it did here, to push up from that level and try to go to the next one. That will give you the structure of the range, but if price action breaks out, it could be classified as a breakout. I hope that helps.
Yeah, it does. Okay. And Andy wants to know, could you have your fib values again, please? Absolutely.
The fib values are simple. You need to right click or double click on this here, on this dotted line. And the fib values are this: 0, 0.3, 0.618, 1, 1.618, 1.32. You just take a screenshot. Use a snipping tool or just take a screenshot. And I'm going to explain what they all represent. Sorry. There they are. And I'll explain in a second exactly what each level means.
And guys, this is recorded, so this will be on the website by tomorrow.
Now I'm going to show you what this represents. Let's, for example, go down to the hour chart here on GBP JPY. We have this top. If I'm looking to go long, the 100% is on top of price action, and the 0 is at the bottom. So in this case here. Your entry levels are 61 and 54. Entry levels are 38.2 and 30. The other levels, including the 100, they are now profit targets. These are profit targets. Now, if you're looking to go short, if you go long, like I said, 100 has to be pointing up and 0 has to be below price action. And if you're looking to go short, for example, here, taking this low to this high, you're looking at 100 being below price and 100 being above price. Your entry levels. That's it.
Fantastic.
Any more questions? Since we ended a bit earlier, it's Friday. I did want to talk about more about mental stuff, but combining it with some processes that I use to make my trading better.
Doesn't seem to be any more questions. So no, I think
that's it.
I think we're done. Okay.
Okay.
Denis,
good.
Thank you so much for your time.
You're very welcome. Yeah, we'll talk about next week. Yeah.
I'll speak to you tomorrow and we'll set up times for next week. All right.
Thank you all. Thank you very much.
For your time.
And I'll see you all next week. Bye-bye.
Fantastic.
Thanks, Dennis.
Have a good weekend.
Bye.